People were worried about not only our markets but what was happening in the global economy and global markets. There was a time when almost all asset classes were under pressure, and most of the assets, equities, bonds, emerging markets, currencies, they all became quite linked with the crude oil. And if you remember, our view was that if we see a recovery in the crude oil price, that takes the systemic risk that people were fearful about away. China would do a stimulus which would probably take away some of the concerns that people had about the Chinese economy and the Chinese currency. Some of the other central banks like European Central Bank and Bank of Japan would do more stimulus. And once the overall commodity prices start moving up, that would lead to some stabilization in the emerging markets, which had come under tremendous pressure. And because of the cheap valuation, when the view on the emerging markets turned positive and flows towards emerging market turned positive, India would also get those flows, and things may change globally as well as in India. People were also cautious ahead of the presentation of Union budget as well as what happens in the monetary policy next. But since February, things have changed very dramatically. As expected, oil prices moved up. In fact, from a bottom of around $27 per barrel, prices have moved up by almost 70% to $46, $47. And lots of concerns which were there because of the sharp fall in crude oil prices, what will happen to some of those economies, what will happen to several companies in the energy sector, can that create a geopolitical crisis, can that create a crisis in the banking system, so on and so forth. So the oil prices going up, and with that most of the other commodity prices moving up, gave a sigh of relief to global investors. Also, the stimulus by the Chinese authorities was very, very large. China has pumped in more money in last quarter than they did after the global financial crisis in 2008. Of course, as a percentage of GDP, that's small because their GDP has grown, but in terms of sheer amount, the stimulus was very large, and that provided some relief in the Chinese economy. And also with the renewed Chinese demand, the restocking led to the generalized rise in the commodity prices. Commodity stocks had gone up, emerging market currencies and emerging market equities started doing well, flows turned positive. European Central Bank did some stimulus. Bank of Japan moved the rates in the negative territory. US Federal Reserve sounded little dovish. And all these things put together provided relief to the global markets. India also got a lot of flows from the global investors. So since March, India has got close to $5 billion from the foreign investors. Budget turned out to be positive with the focus on fiscal consolidation as well as some of the other growth inducing measures, particularly the measures to prop up the rural economy. After that, RBI not only cut interest rate by 25 basis points, but more important is the focus on improving the liquidity in the banking system, where they mentioned that from a period of negative liquidity that we have in the banking system for a long time, over a period of time, RBI's intention would be to move towards a neutral liquidity, and that came as a positive news. In terms of the government action, apart from some of the legislative action in the previous budget session as well as in the current session, the passage of a bankruptcy code that you are aware yesterday it got passed, but in the last session the passage of the real estate regulation bill, the minerals and mining amendment bill, some of the other announcements in terms of whether it's a direct benefit transfer or the announcement of the new national agriculture market, the reduction in the savings rate, the restructuring of the distribution companies, and the issuance of Uday bonds, so on and so forth. I can just go on. I think several executive actions as well as some of the legislative moves have been quite positive. Now, most of it has led to the rally in the market, where we have seen when the beginning of the year Sensex fell from around over 26,000 to a low of around 22,500. We are back to now close to 26,000. Currency that fell from around 66, 70, 80 to almost 69 is back to 66, 80, 85. The 10-year bond the yields have come down to 745. Where do we go from here? My sense is that first, I mean, in terms of the global economy, the stimulus by China has been excessive. Of course, it has provided relief, it has brought a good cheer to the global economy and the global markets. But of course, some of the concerns related to the excessive debt levels in China or the excessive focus on the investment-led growth or property bubble has not gone away. And you may see a mixed bag of news coming in from China, and that will lead to more volatility in the commodities market. That in turn can impact the news flow from the emerging markets. As we move in the next month, there would be some news flow related to the Brexit, which is the referendum in Britain, where people would like to stay within the EU or not. That may also create a little bit of volatility, as well as the central bank's actions. We have clearly seen that over the last couple of months, the more central banks are printing money or increasing the quantitative easing, the incremental impact on market is becoming less and less. So when Bank of Japan moved rates in the negative territory, when they increased the amount of quantitative easing, the Japanese yen, instead of depreciating, which was the desire by the Bank of Japan, actually appreciated. So increasingly, markets are saying that the incremental monetary policy is not going to enthuse us. We actually want more fiscal reforms, fiscal spending. We want some of the other structural reforms to prop up the growth. And the impact of central banks on the markets, equity market or bond market, is becoming increasingly limited. From the India's, so I think we are going to see slightly higher volatility in next few months in the global markets. Equity markets have run up quite sharply across the world. I think probably we may be in a period of slightly higher volatility, not as much as what we saw in Jan and February, but maybe more than what we have seen in last 2 months. Coming to the India, I think from the economy's perspective, there are lots of signs of green shoots. And if I look at some of the anecdotal evidence and some of the data and facts to put on the table, if I look at petrol and diesel consumption, if I look at commercial vehicle sales, passenger car sales, air traffic, you look at the higher occupancy in the commercial real estate, which has started improving. Even I talked about the CV sales, but even the freight rates have been moving up. Indirect tax collections are moving up. Even adjusted for the the increase in the tax rate, the overall indirect tax collection has been going up. Coal production, electricity generation, several things that I can talk about. Hotel occupancy, I think I talked about. There are signs that something is happening. The urban economy seems to be doing well. Urban wages seems to be holding up or rising well. There would be impact of the 7th pay commission going forward as discretionary consumption goes up. The pain point which was there in the rural economy, I think if the monsoon is good as expected, whatever we have heard from the WMD as well as SkyMet and some of the other agencies, if after 2 poor monsoon, the next monsoon is good, I think that should revive the rural economy. The government, higher spending by the government for the rural areas, whether it's irrigation, rural roads, rural electricity, will also help in revival of the rural economy. I think some of the other measures that have been taken in last few months for the overall reforms in the agriculture market, in the rural economy, will also have the positive impact. The focus on some of the infrastructure, particularly the railways and the roads, power T&D, I think that will also help. There are some pain points surely. I think whether it's the excessive NPA levels or the excessive debt in part of corporate India, looking at the global economy, it will take time for exports to revive. The private capex will surely take time. So these are some of the pain points, but to me, I think there are good number of signs that show that I think economy is reviving. And you look at the earnings season, which is, we are in the middle of the earnings season for the 4th quarter of the financial year 2015-16 or the quarter ending March 2016, there are some positive signs. I mean, it's been a mixed bag, but overall I would say it's better than what people feared before the beginning of the earnings announcement. Overall, I think around 400 odd companies have announced the results, and revenue growth is around 6% so far. The profit growth is around 8-9%. Of course, there are lots of companies which are yet to announce results, and the numbers may change in the month of May. But I think by and large, it's not as bad as what most of us feared before the announcement of the earnings season. So I think as we move forward, if we believe that earnings have bottomed, the overall economy is showing signs of revival, then I think over a period of time, markets should do well. But as I mentioned a few minutes back, that we have seen a good recovery from the bottom. Markets have run up 15%, and I expect higher volatility in the global markets, and I think markets should consolidate here for some time. And as we move towards the next quarter, and once the belief is that yes, urban economy is doing well, the rural economy is likely to do well. Once we have more better news on the monsoon, the government spending, government execution is on track. I think over a period of time, with the revival in the economy, as the nominal GDP starts growing at 10-11% and the corporate profitability revives, I think one can expect, let's say, 12-14% returns from the equity market, looking at where the valuations are. Talking about the valuations, I think as of now, looking at the consensus earnings and where the market is, I think we are at around 17 times, slightly higher than the long-term average. I think one shouldn't expect a sharp rally, but I think even if the valuations remain at these levels, looking at a situation where next couple of years the earnings growth may go back to the normalized range of, let's say, 13, 14, 15%, in line with the recovery in the nominal GDP, then these valuations can sustain and one can expect returns in that range. Coming to the bond market, I think after the RBI policy announcements and with the clear direction in terms of improvement of liquidity, where our numbers suggest that out of the net borrowing program of around 4,25,30,000 crores, at least one quarter of it, more than 1 lakh crore, will be absorbed by the RBI itself. There are going to be open market operations of, let's say, at least 1,20,000 crores or so, and that will reduce the supply pressure. Where the supply pressure can come from is higher borrowing by the state governments or some of the Uday bonds, the restructuring of the distribution, the electricity distribution companies, which will be converted into the bonds. Maybe that can increase the supply, while the demand may be slightly less by the banks with lower SLR demand, and at some point in time as the credit growth improves. But overall, looking at the demand supply dynamics, looking at the overall growth inflation dynamics, where we believe that there is going to be a gradual recovery in the economic growth, but inflation is likely to remain at around 5%. There has been a slight negative surprise in the last month's inflation number, CPI at 5.4, due to the rise in some of the agricultural products like fruits, vegetables, sugar and all. But I think overall we as of now believe that if monsoon is good, inflation is likely to hover around 5%, and that will leave the room for probably one more rate cut in the August policy once RBI is confident about the food inflation, how the monsoon goes in next 1 or 2 months. So I think bond yields are likely to stabilize at the current levels. We do not expect a very significant rally from here on for the reasons that I mentioned earlier. So we believe probably a stable to slightly downward bias in the bond yields, and I think after this volatile period of maybe few weeks, once we get the better news on the monsoon and the overall economic recovery, I think the market starts the next leg of the up move. What we are doing as a fund house, I think we remain focused on bottom-up stock picking. We have seen in last 1.5 year, 2 years, 1.5 years exactly, when the markets have been on a downward trajectory when we look at Sensex or Nifty or BSE 100. But several of our funds could generate positive returns, a very decent alpha over the last several years. And I think Main reason behind that is our focus on bottom-up stock picking, avoiding sectors which have been under pressure. In fact, when I talked about the earnings growth, if I look at the earnings growth of our universe, the stocks which are there in our portfolio versus the overall market, there is a very significant gap. I think we could avoid the sectors or the stocks which have been showing depressed earnings, and I think have been staying with companies where the balance sheets are fortified, where the corporate governance has been good, where the growth of the overall business has been better than the market, where the overall return ratios or the profit growth has been higher than the market, and that has kept us in good stead. We have avoided stocks related to commodities like metals. Of course, there has been a technical rally in last 1 or 2 months, but over the last couple of years, I think be more cautious on sectors which may get impacted by the global environment. Corporate lenders, because of the situation in a part of the corporate balance sheet, so whether PSU banks or the other corporate lenders, or some of the staples, because of the valuations, we have been staying away, while the focus has been on the quality stocks within the industrials. Within financials, we have been more overweight on the retail lenders, some of the private sector banks as well as the NBFCs. Cement has done well for us. Consumer durables particularly has done well for us. And there are few companies here and there in chemicals, agrochemicals and all. And one of the interesting thing I would like to highlight is that over a period of time, as we have been mentioning in last several years, that a large part of the economy which is doing well but is not represented in the stock market. Service sector, for example, which has been doing well, the new companies, new businesses are emerging which were not represented in the market fully, but we are seeing several of these IPOs. I mean, you would be knowing the companies that I am talking about, and in several of them we have participated, and some of those stocks have done very well for us. So the focus on bottom-up stock picking through the fundamental research that we have been doing, and able to identify trends, able to identify companies that could do well, have kept us in good stead. And I don't see any reason that over the next several years, as the overall macro improves, we benefit from that, but the larger focus as a fund house would remain on bottom-up stock picking. On the fixed income side, our focus has been at the short end of the curve, 5 to 7 year in the GSEC, which we believe that provides a better valuation, provides a better value for money. We believe that the overall yield curve can steepen a bit, so I think that's a sweet spot for us. And also on the credit side, we continue to remain cautious given the macro environment, but have been able to deliver very good returns across the fixed income funds with a cautious approach on the credit and the liquidity side. But overall, we believe that as the spreads have widened due to the some of the challenges in the credit market, I think there are significant opportunities, and over the next several years, I think we would like to grow that part of our business as well. So maybe I'll stop here and would be very glad to take your questions. Thanks for joining us.